Hey, everybody. Welcome to week 222. Welcome back, Cotter. If you are too young to know what that is, Google it. Welcome back, Cotter. So, hey, we're welcoming back Adam Boatsman. He's better than Cotter. Doesn't have the big afro that Cotter had, but he is a very good teacher. And we've got Jack Santinello back on, and he's a great teacher. And he also has some dad jokes because I sent him some really bad ones with, was it? I think it was Will Ferrell doing some dad jokes. They were bad. So anyway, welcome. You know the drill. Hit us up in the Q&A if you have questions, which I hope you do today, because we're going to talk about the dumbest tax mistakes business owners make. Among other things, I'm sure. We'll see where it goes, but that is the topic for today. So, if you've made any of these, welcome to the club. You're in good company, but what we're trying to do is help you avoid making these mistakes, or anybody that's younger, learn from your elders and avoid doing the dumb mistakes. So before we tee it off and throw it back to Adam, Jack, I'm sure you've got some, Cliff Clavin updates. And so go ahead and take it.
Yeah, actually, let me interrupt him. What I
Yeah.
do want clarity on is who's Vinny Barbarino, who's Arnold Schwarzenegger, Arnold Horseshack, and
Horseshack.
who is Juan, whatever his last
Oh,
name
oh,
is.
oh, oh, oh,
Anyway, have fun with that, Jack.
Are we giving away gift cards in the first
I
two
think we
minutes?
might.
So
Yeah, who gets to be who? Yeah. There you go. Yeah.
okay, well, okay. No, I can't even do it.
You're cool.
Like,
Yeah,
Mr.
of
Yeah.
course, I got to be Travolta, right? I mean,
Yeah. There you
it's
go. Yep, you
an
get it.
Italian thing, right?
Yeah.
All right. So I want to throw out some stats out to everyone for this was in the Charlotte Ledger earlier this week, and it was a survey amongst small business owners in Charlotte that business owners are optimistic and more likely to rate their businesses as successful than counterparts elsewhere in the country. Hopefully you're part of that sentiment. But a US bank survey found that 99% of those surveyed in Charlotte said that they were optimistic about the future, compared with 87% nationally. 98% rated their business success as successful versus 90% nationally. And 95% said their businesses had grown in the past year, compared with 73% nationally. Now, what I don't see in here in the snippet is who was surveyed, meaning, okay, what is the number, what are the what do you call it, the plus and minus, the statistics. The kids would know all about that, but all the variances and everything else that go into that. But it was interesting that at least it appears that Charlottean business owners are more optimistic than the national sentiment. So, and I don't know if that is because of things that are going on in Charlotte, if it's I don't know exactly what that is. I've lived here for over 35 years, so I don't know if you guys have any thoughts on why that might be. CFC is not doing much better than they did last season. Panthers still to be determined. So I don't know what is bringing the more joyous perspective amongst Charlottean business owners.
Well, part of it is just, the last thing that I had seen was, I thought it was either Charlotte or North Carolina were the second most moved into states in the country. So it's either states or cities, but I think it was states. And then I also think 28277, which is Ballantyne zip code, was one of the top zip codes of fastest growing, most people moving into. Those are things that I saw recently. So I have a feeling that some of that is in play. I don't know.
Yeah, I would say also in the same, there's a report from the Charlotte Regional Business Alliance, so otherwise our Charlotte Chamber, set 117 newcomers a day to the region in a recent report. So over 100 per day on average coming to Charlotte. And I know that many of those come to Charlotte without having a job. They feel like there's opportunity here, and then they seek the opportunity and hope that everything works out versus having an opportunity lined up for, certain income and those kind of things. So,
Yeah.
I'm obviously a fan of this city and raised my kids here and dragged my wife back to here from where she wanted to be otherwise. So,
Where else would you want to be, man? I mean,
she's a beach person. She's
oh yeah, there
Charleston,
you go.
Charleston.
Yeah,
So yeah,
yeah, you're close enough.
yeah, exactly.
Compared to Kansas, we're living on the beach right here in Charlotte. We're beachfront. And Jamie Boyder did get right. He said the Charlotte region 117. And Joseph says Mooresville is where it's at. That's what they say. So there you go.
Yes. All right. That's pretty much it that I just wanted to share those stats. So don't want to take any time away from the reciprocal, I want to say dumb things that business owners do. Sorry.
Yeah, fair enough. Yeah, well
It's a
put,
legal
Jack.
term.
Well put. Yeah, so quick thing before we kick off. Did a LinkedIn post about this as well. And it's just fresh in my mind because I was at breakfast with a client and was asked the question, they're going to tax me on my unrealized gains. So that there has been bantied around from the Democrats a proposal to tax unrealized gains. It was brought up before. It's part of what the Harris campaign has put forward, meaning like, if I've got $100 in Apple stock and it's now worth 500, I would get taxed on the 400 spread, even if I hadn't sold it. So that's the proposal that's out there. Obviously, it would have to pass before it comes something. And I guess it again. I'm neither for it nor against it, so I'm just going to explain what it actually is, and then what they're kind of trying to target as a behavior with it. So the the stuff that's, if you read stuff out there, it's like, Harris is going to make, Timmy sell the family farm, if this happens, or we're going to have Jack, you're going to have to sell your share in Shoemaker and I'm going to have to sell my share in BGW, if this happens, because that's an appreciated asset. So, the first key thing to note is that first off, this is only going to target people that have over $100 million in liquid assets. Of which by the proposal's estimation is 10,760 people in the US. So in terms of tax proposals, this one's pretty freaking targeted on about 11,000 people. And, the behavior pattern that they're trying to discourage is that when I have that kind of money, I actually don't have to pay taxes. And the way that I don't have to pay taxes is that typically when you've got people are really familiar with it in terms of home equity loans, like I'm borrowing against an appreciated value and turning that into cash. So you can do the same thing with your investment portfolio where, if I've got, $100 million invested, typically every investment house that would hold it would loan me at least $50 million against it. So I don't have to sell a dime. So I got 100 million invested. It's earning 8%. I get to borrow 50 million. And with that 50 million, I can do anything that I want. I can live off of it. I can invest it in other assets that I never sell that then I can borrow against, as my portfolio goes up. And it's like, you kind of create this never ending, thing. In theory, when you die, it would become part of your taxable estate. But wait, Jack, there's more. If hypothetically there's more fabulous cash and prizes. Hypothetically, if a friend asked me for a way to stick it to the man, I might say something like this: Jack, why don't you take out a loan of $50 million? Go buy, air quote, a piece of commercial real estate. However, you're not actually buying it. What you're doing is you're setting up an LLC that's owned by your children. and you're just simply loaning that entity money, but they own it, so now the building is in the kid's name, appreciating in value, and all you got is a loan against it. So you're not growing your value anymore. You're growing your kid's value, and effectively bypassed the estate tax in totality. So everything basically passed tax free. So I'm actually a big fan of this as a tax strategy, by the way. Like it's one of my favorite tax strategies, and it's also one of my favorite it's one of my favorite ways for a business to potentially finance itself if it needs to. It's actually how I bought our house in Ocean Isle, like that we rent out. I mean, that was a combination of a home equity loan against my property in Davidson, plus a loan against an investment account. So it's a perfectly viable strategy that I really like. So it's just remember what they're before, we call it doom and gloom. They're targeting 11,000 people that kind of never happen. Trust me, I paid tax. So I think what I could see happening would be some sort of like, to me, what would seem to be fair would be that instead of taxing unrealized gains totality, tax margin loans, because that is sort of a disguised sale, in some respects. And because otherwise you would have had to sell the, or just do something, with the margin loan, like some nominal tax on it. So anyway, that's the unrealized gains tax. I don't see it. I'd have a hard time seeing it passing because it would create so much complicated record keeping, because if I paid taxes on part of it, then what's my basis when I go to sell it? It's just, I don't think the dog's going to hunt, but just that's what they're targeting. So anyway, kicking into the top 5 dumbest mistakes that we see people make. And I may go into more than 5. Jack, you got your opportunity to consult my new BFF, ChatGPT, to see if she has anything to say about the matter. But the 2 we covered in the previous session was get my grammar right there. I didn't go to Carolina. I went to Arizona State, Jack. So, so they were printing degrees on toilet paper around that place. So Jack's laughing. True that.
I was there. I was actually there a couple of months ago. I was very impressed with it. So yeah, no,
it's a nice campus.
It is.
So the 2 that we covered in the previous call, accounting method changes, which were basically the ability to go from an accrual basis taxpayer to a cash basis taxpayer, which if you're growing is going to allow you to defer your taxes for a period of time. And then also, modifying your method of inventory. And what a lot of people miss is, first off, that those methods exist in the first place. And then secondly, if they knew they existed, they didn't get the memo that as part of the Tax Cuts and Jobs Act, the ceiling was raised from 10 million up to 25 million indexed for inflation. So we've been able to help a lot of people with that move. The second is related to what's considered reasonable compensation. And, if you go back and play the video, Jack and I had a good back and forth where Jack was trying to prevent disbarment. And I was trying to be aggressive. So it's a good one to listen to. So the next 2, I don't think this would lead to disbarment, Jack, but the next 2 that we see that are problems are actually closely related to each other. And that is deducting allowable owner fringe benefits and then record keeping. So in terms of deducting allowable owner fringe benefits, people just, there's really one of a few different problems that we find with people when it comes to owner fringe benefits. Problem number 1 is they just don't know what's allowable. Like they're not, they don't wake up in the morning to go run their business saying, I wonder what I can get away with deducting, or what's allowable under the tax code that I can deduct. So they don't ask the question, they don't educate themselves as a practitioner, unless I prompt somebody about whether or not they're doing something. Like, it's not going to be clear from looking at somebody's profit and loss statement whether or not they're actually taking advantage of owner fringe benefits. So like it requires that someone in my seat has to prompt the ownership team to kind of trigger, hey, are you doing this? Or not, or hey, here's something that you can do. So that's kind of issue number one. It's just unaware, that you can do something. Classic example would be, paying the kids for legitimate work. It's like some people know about that, some people don't. You're not going to know it unless you've read about it or were prompted about it. Like, they don't, when you go to get your MBA from Carolina, they don't teach that in the tax course. So at least not as far as I know, Jack. So that's challenge number one with the owner fringe benefits. Challenge number two is your internal person works for the IRS and you didn't know it. And beyond not working for the IRS, they actually do worse than work for the IRS. They're sort of like Gomer Pyle in that old episode of Andy Griffith, citizens arrest, citizens arrest. Like that, your internal person actually doesn't even know what's allowable, so they think they know, so they call the arbitrary conservative strike. And how does this show up? How this typically shows up is, Gary has the corporate Amex card, and Gary's heard that I can deduct business meals, so I'm going to deduct business meals. Sally, Gary's controller, who, I'm not saying that some people exhibit hypocritical behavior, but perhaps she is one of those that she without sin should perhaps cast the first stone, and she's ready to cast stones.
I think her name is Karen.
Karen, yeah, Karen. That's Karen, yeah. So Karen says, you can't do that. So Gary unwittingly thinks that he's getting fat, dumb, and happy, deducting these meals that he's perfectly entitled to deduct. And Karen is going right behind him and coding them to distributions, which would be a balance sheet activity, not a deduction. Because she doesn't think that they're legit. Never consulted Gary. She just did it for Gary's good. I just want to make sure, Gary, I want you to stay out of trouble, and I can't have my name associated with that. Because I don't want to go to jail, which is just insane that somebody would actually think that. But I'm not making this shit up. These are conversations that I've been involved with more than once. Is that Jack's hopping on the phone? He's
I'm calling our controller right now. Yes.
Yeah, I was gonna say. I thought you were like getting a call from the Shoemaker legal department. Get off now. Get off now. So that's so Gary doesn't even know. Like, and I'm not gonna know unless I go looking in the distributions account on your balance sheet to see what's in there to say, dude, why are these credit card charges not legitimate expenses? We're talking tens, $20,000, $30,000, this could add up to that Karen's making decisions on your behalf about what's legitimate and what's not legitimate. So that's where problem number two arises. Problem number.
Let me throw this in there too. In all seriousness, our controller here is very good about making sure it's legit before she does reimbursements or she does anything else. So, for example, and I was kind of initially annoyed by this, but I pay the $32 per month for the LinkedIn Pro, whatever it is, and it's on my credit card, and I seek reimbursement for it, and I gave her a printout of 1 month and said, multiply that by 6. So I do it every 6 months. She's like, I need to see the printout of every month to make sure. And not that, I mean, I've known her for well, over 25 years. She's been here longer than I have. And that, but I want her to do those things with other people. So it's not a matter that she's not trusting me. She just needs to make sure that everyone else is doing what they're supposed to do and it's legit. So my recommendation is, you know, as a business owner, have that discussion with your controller so that they, first of all, are empowered to ask those questions of people and they don't feel self-conscious about it. Because, you know, I could have very easily said, you know, who the F do you think you are? I've been an owner in this firm forever and kind of thing. And I'm not going to do that because we have empowered her to ask those questions and to treat everybody equally so that there is objectivity in our financials.
Yeah,
So.
That's right. That's right. So again, it's not the end of the world if somebody's doing it. It's just that it needs to be a person who actually understands the rules. And I like what you said, Jack. At least you knew it was happening versus a lot of people just don't even know that it's happening behind the scenes. They assume they're getting a deduction and they're not. The third is which I'll bleed into the record keeping here is that I actually know what I can do and I just don't do it. You know, because I'm busy, you know, and I got busy, you know, I extended my tax return. I haven't really kept up with my records too much. And I know I should do that, but I'm gonna have to go back and like look through some bank statements and find stuff. It's just too much of a hassle. Well, I mean, you know, without trying very hard, I can usually find about 20 or 30 grand of owner fringe benefits on a typical company, you know, that would be allowable. You multiply that times a 30% effective tax rate, that's going to be anywhere between, you know, $6,000 and $10,000. That is real cash. You know, it's like, I mean, it might take you 8 hours. Like I haven't done the math on this, but if I took $10,000 divided by 8 hours, that's a pretty good freaking hourly rate, isn't it, Gary? You know,
it's higher than Jones' day.
yeah, to make it worth, yeah, would it make it worth, maybe not Jack's rate, but you know, my rate, it's actually higher than. So it's like, is that not worth your while, you know, to go do that? You know, like that's insane that you would not take the time to go do that, to me at least. So I think how that bleeds into bad record keeping, which really comes in and has two kind of forewarnings about it, is that one, you know, when you're not keeping up with this stuff, it's like you just have a tendency to get lazy, think it's too much of a hassle, but there's a real economic benefit, you know. So that's why we're passionate about having people having current financials for a lot of reasons. This just happens to be one of them, because if I'm trying to, you know, if you think about like, what are we going through at BGW right now? You know, there are still clients out there who will remain unnamed who are just now getting us records for 2023. Last time I checked, it's September 5th of 2024. So the odds that they actually will even remember an expense from February 2023 are pretty freaking low, you know. So it's kind of, you know, in some respects, it's just kind of their loss, that by not keeping up with it. But bleeding on into the, you know, kind of the third item, or the fourth item, which is bad record keeping. So we always advocate keeping as much, like keeping complete separation. And because I can't even say is administratively feasible, because that would be giving somebody a pass to say, well, maybe I could do some because it was easier to make my mortgage payment through the company than it was, you know, versus doing it. I mean, you need to keep complete separation between your business and your personal records. And the reason for that is that if you ever are, let's say, you know, legitimately, you know, benevolent Jack is going to host a barbecue, you know, for his team, you know, and he's going to do it at his house. He's going to cook all the food, and yeah, it's a legitimate business expense. So you damn right he's going to submit an expense reimbursement on it, or otherwise put it on the company credit card. If Jack bought a whole bunch of personal items in that same Costco run on the same receipt, it's not that the legitimate ones aren't deductible. He just made the case harder. You know, because now I'm having to argue that those frozen hamburgers were for the barbecue, but those frozen hamburgers were not. You know, and it's like, well, I mean, that's crazy. Like, how do I know that? You know, so you were gonna ask a question, Jack?
Yes. How about the scenario where my intentions were, or this hypothetical, Jack, were to buy stuff for the barbecue, and let's say maybe a little aggressive at the ABC store, and some extra alcohol ended up in said Jack liquor cabinet. Is that fully deductible, or do I have to partition what was actually used at the party?
I mean, the theory, you know, so I would have fully deducted it. I mean, I suppose somebody could say, hey, you should only deduct, you know, part of it. But to me, it would have been, I don't know what kind of parties you're throwing, Jack, but I mean, you pretty much, let's say that, you know, let's say you spend $1,000 on liquor and you got $300 left in liquor that goes in the sand yellow liquor cabinet. You know, that's going to equate to $100 in tax, and the IRS is going to pass on adjustment for that. So I'm not. Good question. You will not get disbarred or get thrown in jail for that one.
Okay, good, because that's one of the incentives to get other people, not myself, to host things. Is like, hey, by the way, whatever's left over,
Yeah,
hey,
just saying, saying for a
just
friend,
saying.
yeah, just saying for a friend, yeah, yeah. So I mean, it really the record keeping comes down to, you know, one, you forget or you miss stuff, and then secondly, if you're not clean on your records, then you just you make my basically you create an unforced error that I would just soon not have to deal with. You know, it's like great, now we're gonna have to pay the stupid tax. That, like, in other words, like, I want to be debating the legitimacy of an aggressive deduction versus having to justify that you just forgot on your kitty litter. You know, because otherwise that's gonna, you know, because you know how it goes. It's like, well, if one thing's wrong, then I'm going to assume that it's all wrong. You know, versus, oh no, we just made a legitimate mistake. You know, so keep it clean. You know, that's number, stay classy. You know, that's number 4.
And Adam, related to that is the piercing the corporate veil. So the legal
Yep.
aspect of that is, and I don't know if we were going to mention that, and I'm stealing your thunder.
No, hit it,
Okay.
maybe hit it.
All right. So, the concept is when you set up an entity, I mean, just the fundamental reason is to keep your personal assets protected from your business liabilities. And as I've said before, and apparently I've offended other people by saying this, but I'm going to say it anyway. You do the bonehead things, and you have basically obliterated that line between the two, because you have now exposed your personal assets to business liabilities because you're acting on yourself rather than as a representative of the business. And there's a whole doctrine around that. But the concept, one of the biggest ways and common ways to obliterate that line between personal assets and business liabilities is to have bad record keeping, which is to essentially do things like you had mentioned. Okay, well, I'll just pay my personal mortgage out of the business assets because it's an S corporation. Eventually that distribution will get down to me. It's my money anyway. Yeah, I'm going to pay taxes on it, but I know my net is going to be this number, so I'm just going to have the company stroke a check. No, it has to happen that company pays you, you pay your mortgage, you pay your boat, you pay whatever it is that you're paying for personally. And so what that does is it gives a creditor ammunition to basically say that you have not complied with corporate formalities, so that there is no legal separation between the business and you. It's all one, and it's a sham essentially. And even though the check says business, you're using it for your personal. And so now we're going to come after you personally for whatever that liability is, because you have now blurred that line or obliterated it, as I said. So it's just that's the legal aspect of the bad, well, amongst others, bad record keeping, is that you expose your personal assets to your business liabilities if you don't do it, if you do that.
Yeah, no, that's totally fair. So then the fifth, and then we're going to go into bonus round, unless unless the audience has some questions. The fifth really comes into more structural type items in the event that you're going to have a sale of your company. So that's kind of a broad category, but it, what people, when somebody gets an offer letter and they say, "Oh man, I'm going to sell my company for $20 million." I mean, that's interesting information. What really matters is, what are you going to put in your pocket? And the problem is, people, like, they know they should probably figure that out, but then they don't until they're too far down the road to do anything about it. So in kind of reverse order of timing, the first big dumb mistake that we see people do, from a structure standpoint, is, they own a C corporation and they agree to an asset sale, period, full stop. So when it's a C corporation, you have two elements of tax. Tax number one is the C corporation sold its assets and it pays tax. Now there's cash that's left, net of the federal income tax, and I want to distribute to the owners. Well, the owners now pay tax. So basically, you now have an effective, call it 35% tax that you just paid, that, had it been any other structure, would have been 20%. So right out of the gate, and again, if you already went down the path of agreeing to it, and you're deep in negotiations, it's hard to get that fixed from a structure standpoint. But some of the ways that you can mitigate it are, since the buyer is doing an asset sale, presumably to not have any contingent liability, but in reality, it's because they want tax deductions. In other words, like, love you, Jack, but how many people really were concerned about contingent liabilities in asset sale versus they wanted to be able to deduct the purchase? Like, if you really boil down to, what are we truly looking for? It's for a tax deduction for buying your company, which I'm only going to get with an asset sale. I'm not going to get with the stock sale. So, so a lot of times what will happen in that scenario is that at least the seller should ask to be grossed up for the tax difference, had it been a stock sale versus a asset sale. And oftentimes, the buyer will at least meet in the middle. A lot of times they'll make the seller whole, because it really benefits the buyer to do an asset sale, which is really just to disguise additional purchase price. But that's mistake number one. It's just, I'm deep down. Then finally I see, oh, what's my net proceeds going to be? Wait a second. I'm selling my company for $1. I thought I was selling my company for $20 million. Like, that's ridiculous. What can I change? And then from the buyer's perspective, they're like, wait a minute. Like, how many buyers like getting asked for more money after their initial offer, Jack? Yeah, you're on mute.
I don't know. Tell me how many.
No. Zero. Yeah.
Negative? Can we
Yeah,
are we doing negatives, or are we doing full integers? Right?
Yeah, I guess negatives would count with deal blows up over it. So they don't like that. But, so what are some other mitigating strategies? Another mitigating strategy is that, you know, in a C corporation, assuming that certain factors are met, you know, primarily that the owner doesn't have a non-compete in the existing company that he or she is selling, and a few other things, you have the ability to do not one transaction, but actually two transactions. So you're selling the company, but then what you're also selling independent of the company sale is your own personal goodwill, which is a sale, which is basically all the extra intangible stuff that they were giving you as a premium in your purchase price anyway. That is subject to capital gains tax at your individual level, no double tax at all. And oftentimes, you know, we can make a case that that's, you know, of the goodwill portion of a transaction, you know, pretty easy to get to, you know, 75 to 80% of that component, you know, is considered outside of the sale itself and is between the individual owner and the buyer. Buyer shouldn't care because they're getting the tax deduction regardless of the transaction. But it can slow things down because you're supposed to get a valuation done to support it. And again, it's one of those things where, hey, 11th hour, now you're throwing this into the mix. Now we've got to have two closings, you know, not one close, like, I don't know, yeah, blah, blah. But it's a lot of money, you know, that you're leaving on the table if you don't do it. The third thing that is a little bit more requires a lot more timing, you know, associated with this. So both those could be like, you know, pretty close, you know, to a transaction. The third thing that needs to be a little bit further out from the transaction is any sort of pre-transaction planning. Like if I was going to do any gifting to remove the proceeds out of my stake, because like, you know, if I've got a company I'm selling for, you know, $50 million, you know, before the sale, I don't know if it's really worth $50 million because I don't even know if I've got a transaction. After the sale, I am worth $50 million, you know, because it's cash money with a readily discernible value. So my ability to do kind of any creative estate planning goes to zero post-transaction, whereas pre-transaction, I've got some opportunities. However, you know, despite my feelings on the subject, it's hard to get estate planning attorneys to get really aggressive one day before a transaction. You know, I don't know what they do there at Shoemaker, but sometimes I've been told, I'm not signing that document.
Never happens.
Yeah, which I can't, you know, I can't really blame them, but it is a lot of money to potentially be leaving on the table from an estate tax standpoint, which is a mostly voluntary tax. So, you know, most people, even the most conservative estate planning attorney will typically be okay with kind of 6 months to a year before a transaction, you know, getting pretty, which could mean that you've got some expression of interest. You know, if you think about how long it takes to actually sell a company, you know, so like if you know that you're going to sell it, like, you know, you're going to sell it, but it's also likely going to take 6 to 8 months to close. I mean, you need to like immediately go into gifting mode. The related to that would be any sort of charitable giving, you know, should really be done pre-transaction, not post, because like, you know, donating appreciated Apple stock, I don't get the donation for my basis. I get the donation for the fair market value. In this case, fair market value is 50 million bucks. So most donor advised funds like Foundation of the Carolinas are set up to hold privately held company stock that they're just now a party to the funds disbursement when the company sells. So they get, you know, the tax, the cash is removed from your gain calculation, thus you are not paying any taxes. But since Foundation of the Carolinas is not for profit, they're not paying taxes either on the transaction. So that's another one. And then the last one I'll hit on that's, you know, more pre-transaction planning, and this one really rolls back to, you know, kind of years before the transaction, is that, you know, if you are a C corporation and your most businesses that are out there, you know, basically, you know, when they did us all a favor by clarifying which businesses will qualify for what I'm about to talk about, when they did the 2017 Tax Cuts and Jobs Act, because they identified specialized service businesses, of which me and Jack are them. You know, But then there's a whole lot of others that aren't them, including architects and engineers. They had a great lobby. Why did our lobby suck, Jack? So, construction companies, manufacturing companies, a lot of things you wouldn't have thought about, as being kind of startup-y, techy, R&D heavy, which is what was really the target of this code section I'm about to cite. Basically, if you're a C corporation, up to $10 million per shareholder per year can be excluded from the gain calculation with using code section 1202. There's some rules around it. You got to hold the stock for 5 years, but if you're a qualifying company, which most of our clients that are C corporations are going to be qualifying companies when they became C corporations, which is the real test, basically the whole transaction is tax-free if you can get it to be a stock sale, which would allow me to accept potentially a reduced purchase price if that was part of the deal. And again, it's 10 million per year. So hypothetically, Jack, just saying for a friend, $50 million transaction, 3-year payout. One day before the transaction, I'm going to give my wife some stock. Now we have not $10 million. Now we have $20 million. And it's a 3-year payout. So we've got $20 million per year of gain that I'm not going to have to pay taxes on, which is an unbelievable benefit, and worth the evaluation. And then last one on this one is that, just like your investment portfolio, if you live in Florida, is not subject to state income tax, because Florida doesn't have state income tax. Same thing applies to selling your company, on the capital elements of that, which would be either a stock sale or the goodwill piece. So you can avoid state tax, but you can figure out how to move your residency to Florida pre-transaction. So that's probably the 5th biggest mistake that we see people. I know I covered a lot of ground here, but that's probably the 5th biggest mistake that we see people make that's out there. I mean, there's other people too that kind of screw up depreciation when they buy a building, which would sort of be my bonus statement. But yeah.
We are very much fans of Section 1202, especially Warren Keene, our resident LLM. So, I mean, it's kind of one of the first things that comes out when there's that type of transaction is, okay, how long is this buyer going to hold on to this? Or, kind of, and asking a lot of questions about the transaction structure. And we've had clients who have said, I know I'm not going to meet the 5-year hold requirement, so we just kind of move on. But it's a question that should be asked in an analysis.
Yeah, no kidding. And again, it really, I think, in one, I'll give you one example where it made a huge difference, just by saying, okay, well, let's see what we can do. We had a client that had 2 companies. One was a partnership, LLC tax partnership. The other one was an S corporation. And they knew there was going to be a transaction at some point in the future, but they couldn't do anything about the partnership. So what we did is we revoked the S election and became a C corporation in the related company. And then with the buyer, since it was going to be an installment sale anyway, we were able to say, well, why don't you buy the partnership first? And that allowed enough time to expire to get to the 5-year mark on the C corporation, which was, huge. I mean, this saved these guys a couple $1 million, in taxes by doing this.
I
I
love
want to
it.
go back to something that you said. Sorry, go ahead, Barry.
I was going to say, and Craig weighed in on this. He said, stack and pack the qualified small business stock. So thanks for
Yes.
weighing in, Craig.
Yep. I wanted to go back to the issue of record keeping, and there's a really kind of a simple way of doing it, which is have 2 credit cards. I mean, keep your personal stuff separate from your business stuff. And I know there's resistance to, well, okay, then I don't get all the miles. I want to get all the miles that I can, or all of the hotel points, or all, whatever affinity card you have. But it's just get one that is just cash back, and either use
Yeah.
that for personal and then use the affinity card for everything else. So you're kind of getting the benefit of both worlds. But it's it does become, and I've seen how when we go through due diligence, when there's a dispute amongst owners as to, okay, is this personal or is this really business related? And you have to sort through a spreadsheet. And we've all seen spreadsheets where it's okay, if it's highlighted in yellow, that's business. If it's highlighted in green, it's personal. And then you have to go through all this allocation versus having just a statement, a credit card statement that is all business stuff. It's less things to fight about when there's a fight going on, essentially. And it just does look better down the road when it's down the road. I mean, as Adam said, 12, 18 months later, you're not going to remember what that's for. And especially if you have, well, you might not even have a receipt anymore. People are not
Yeah.
accepting receipts when they go buy things. And so just the logistics, it's easier just to keep it separate, literally.
Yep.
Yeah, a single card is a good idea. I've got a friend, they were in due diligence on a smaller company. Is like a doggy daycare, right? And they had 28 business cards in a drawer. Just 28. It was not good record keeping, and
Yeah.
it squirreled the deal. I mean, it completely blew the deal.
Thanks.
But can you imagine? That's a hoarder
Yeah.
right there.
I'll hit a bonus one for you, Jack, if that's all right, and Gary.
Yeah, go for it.
So bonus one, and then I do have a hard stop at noon because I got to meet somebody at
Yeah,
lunch for 12:15.
I do
But
too.
the bonus one that we see, and again, these are, in all seriousness, if you do hit up ChatGPT, or you do hit up Google and say, what are the top 5 dumbest mistakes tax mistakes business owner makes, you get stuff like not filing your tax return. So like, keep in mind ahead of time, like, this is the master's class. Like, we're already assuming like a base level of knowledge, that's here. So this one is for all the real estate owners in the room, that commercial real estate, which could even be residential real estate, but I'm renting it out. So excuse me, people that buy commercial real estate, at some point hear the term cost segregation, which really, what that means is that if I buy a piece of commercial real estate, let's say it's $1 million, then what the tax code allows you to do is to carve up elements of that $1 million into separately depreciable elements that have different useful lives, on the recognition that, land is not depreciable. But at the same time, HVAC systems don't last 40 years.
Right.
Which in round numbers is the useful life of a commercial property. Residential 27.5 years. Carpet, not gonna lie. I mean, my basement carpet was 40 years old when I moved in, but typically does not last, 40 years, right? So they allow you to carve out elements of the building into faster depreciable components, typically, 5 years, 7 years, and 15 years. Well, all those elements, given the current tax code, typically qualify for accelerated depreciation methods, which means I get it automatically expensive. So if I've got $1 million property, and I can carve out, typically the rule of thumb is going to be about 25% of the acquisition cost into faster depreciable items, I'm getting a $250,000 tax deduction conceivably right up front, depending on the depreciation method that I choose for it, which a lot of times, hey, that funds the down payment, or at least makes it cash flow positive in the first year, through the tax savings. So someone right now in our attendee list is saying, well, duh, Adam, I've already heard of that one. I know you have. I'm going to talk about what happens when you sell it for a minute. So, the nice thing about that is you just got an accelerated tax deduction. But what do we know, Jack, about, you know, using accelerated depreciation? Well, depreciation in general. What do we know about depreciation in general is that it is just a timing difference. Meaning, like, if I fully depreciate Jack's G-Wagon, Jack does not drive a G-Wagon, I don't think, by the way. Yeah.
An
You would be,
AMG
yeah,
G-Wagon.
you would be pretty bougie if that was the case. But let's say I fully depreciate the G-Wagon, and I'm like, yay, $150,000 tax deduction. Way to go, Boatsman. You're the best. Boatsman is great. And then a year later, you go to sell the G-Wagon. I'm going to have a big whap, 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 whap for you because you've got to basically recapture that 150 grand up to the amount that you actually sold it for. Let's say it's 100 grand. So your net deduction was only 50 grand, because you're having to recapture income. Well, the same concept applies to real estate. You go to sell it, the elements that you depreciated are not capital gain, it's ordinary income. So that, you kind of look at that and you go, well, that kind of sucks. But wait, there are fabulous cash and prizes, Jack. So what's different about a real estate transaction than any other transaction that's out there is that if I do a typical business transaction, I've got to do an asset allocation, to receivables, cash, computers, furniture, all that kind of stuff. That's all disclosed in the tax return, like what the allocation scheme actually is. And the buyer and seller are typically supposed to agree to that scheme, so that they're both on the same, basis of accounting going forward. And if you want to dispute it, you can, like, if I want to do my way and Jack wants to do his way, we can do that. It's just I've got to say that I'm doing that. And since 2006, the number of times that I've actually had somebody dispute the allocation of the transaction has been zero. It's another one of those unforced errors. Just negotiate better, for the love of God. So on a real estate transaction, nay, sir, it's one number on a HUD statement. So I've got flexibility. Again, this gets into wonky, geek speak on the tax side, but I've got flexibility in terms of how I record that sale on my end. And if you think about commercial real estate in general, buy it for $1 million, sold it for $2 million. The building's not what went up in value. It was the underlying dirt that went up in value. So right out of the gate, I can take part of that gain and probably outweigh some of that gain in terms of the allocation of the land. So for example, if I had 100 grand an acre allocated to it, and right now it's selling for 300 grand an acre, right? Hallelujah, right there. That's gonna prevent, that's already gonna right out of the gate give me capital gains treatment that otherwise might have been ordinary treatment. The second thing though too is, so hopefully nobody from Beacon is on this call right now, but there's a good chance that BGW will not stay in 1616 Camden at the end of our lease. We're looking around. Gary's doing the charge, leading the charge, looking a couple places around Fremore, a couple other places. We all got our fingers crossed. Hope it's going to be cool. But anyway, when we move out, what are the odds that our space is going to stay the same configuration? Zero. They're going to demo it, and build it for purpose for somebody else. So the value that they have recorded for their leaseholds on the Beacon side of the equation for the BGW space, they're going to go to zero, because they're going to have to demo it and put new outfits in. The same concept applies when you sell the building, like whatever you did, you know, like that really cool, you know, toilet that you built, you know, with the stand, they're going to demo all that. So why would you allocate any purchase price to it? You know, because it's valueless. You know, they're going to reno the space. So I had the opportunity then to say, okay, my second pass would be, if I'm allocating purchase price, I'm going to allocate as little as possible to the amounts that I did accelerated depreciation on, because chances are those are all going to get ripped out, thrown away, and replaced by the buyer anyway. Thus, I can allocate more towards the shell and core, which I can accelerate depreciation on, but conversely, doesn't have much depreciation taken. So that's the BGW way of minimizing the tax upon the sale of a piece of commercial real estate. Is just really getting, I can't even say that's creative, Gary. It's like common sense, you know, but nobody does it. Like instead they just say, hit dispose, you know, in our fixed asset software. And if you just do that, guess what? The fixed asset software allocates the disposal pro rata, you know, so you actually have to take measures to override it. And that can be, you know, hundreds of thousands of dollars, you know, depending on the property that's sold.
Common sense isn't so common. And you know, here's the deal. Most people that are running businesses, they know their industry, they know their business, but they don't know a lot of these nuances. And that's why it does pay. And this isn't just a plug for us, like find somebody good that knows what they're doing. It'll be some of the best money you've ever spent. We've seen it when somebody was chinsing out, and man, did they pay. You know, back to Fram filters. You can pay me now or you can pay me later.
Yeah,
so
that's right.
Anyway, and same true goes true with legal work. We've seen a lot of really questionable stuff that just, it was not illegal. It just wasn't the best solution for the client. So hire somebody that knows what they're doing.
That's right.
This is good, man. This is fun. And we're 2 minutes away. Last call for any questions.
While people are thinking of questions, I have a random giveaway. It's not a dad joke, but it's the level of randomness, like our 200th week anniversary kind of thing. So quick backstory is yesterday, working from home, went to work, went on a run in the morning, was taking a shower later than I normally do, and The Price is Right was on in the background because I just wanted some background noise. And it got to the end, the showcase showdown or whatever it is, or the showcase. And so then at the end, the announcer's saying, you know, The Price is Right, a something production. And it was a person's name. And it just, I paused momentarily mentally because it isn't what I was expecting mentally. And then I was thinking, okay, how many times did I hear that when I was a kid? Now, for anyone in the next 10 seconds that can, you know, there you go. Craig got it. Okay, but there's actually two people.
Oh, wow. I would not have gotten that.
It is that first name, Craig, and then there's a second name that was his partner. But then that's why it occurred to me that I heard it. It was like, okay, it's a blank and blank production. And so anyway, so Craig, I'll give it to you, but do you remember, does anybody remember what the second name was? Like, yeah, I think you have to play, maybe you have to be playing the Price is Right song in the back of your mind and like, okay, you know, hear that voice and think, you know, Bob Barker saying, please protect the pet population, have your pets spayed or neutered, and then go into the ending of it. So anyway, so yes.
Yeah, I don't know. I don't remember. Bob Barker was the guy. That's all I associated with Price is Right.
Oh, see, Craig got it. You're right on. So Mark Goodson, Bill Todman production. Now that you hear that, if you're a Price is Right fan, you might, yeah. So yeah, Craig, I will send to you your gift certificate, your Starbucks gift.
See, he weighed in on the QSBS. So there you
Yes,
go.
definitely.
Good job, Craig. All right, everybody. So we're at the noon o'clock. So we're going to be at 2:23 next week, Lord willing. And if you got in late, we'll put this up on BGW CPA YouTube channel. Same way with Shoemaker. They've got their own YouTube channel. So thanks for being here. Next
All
week,
right, awesome
2:23.
guys.
See y'all. Bye-bye.
All
Thank
right, see
you.
you. Bye.
Bye.